Welcome back to Algobot, the channel where we break down automated trading strategies for MetaTrader 5, one line of logic at a time. I'm your host here at Algobot, and today we're exploring an expert advisor called the Overextension Snapback Reversal. This is a pure price action, counter-trend strategy, and it uses no traditional indicators at all, only raw candle shapes, closing prices, and swing extremes. By the end of this video, you'll understand how it spots a stretched, tired move, how it reads a rejection candle, and how it places its stop and its target. Remember, this is educational information only and not financial advice. So what exactly does this expert advisor do? At its core, the Overextension Snapback Reversal is a mean reversion strategy. Instead of riding a trend, it waits for a directional move to become stretched and tired, and then it positions for a snapback toward the average, a reversion to the mean. It's a counter-trend approach, which means it deliberately enters against the most recent push, but only at the moment that push shows clear signs of running out of momentum. What makes this one distinctive is that it uses no indicators whatsoever. There's no moving average, no oscillator, no bands. Every decision comes from raw candle geometry, the closing prices, the size of each candle's body and wicks, and the recent swing highs and lows. In effect, the strategy is reading the chart the way a discretionary price action trader might, but with strict, repeatable rules. It combines two ideas. The first is context. Has price traveled an unusually large net distance over the last several bars compared to its own recent rhythm? The second is a precise condition. Did the most recently closed candle print a pin-style rejection at a brand new extreme of that move? Only when both line up does the strategy act. The defaults are designed with gold, that is XAU/USD, and pound sterling to Japanese yen in mind, on the 5-minute and 15-minute time frames, though the logic can run on any liquid symbol and time frame. Because it's counter-trend and rule-based, it may appeal to traders who are studying exhaustion and reversion patterns and who prefer a fully defined stop and target on every position. As always, this is educational information only, and trading carries real risk, including the risk of loss. Let's walk through the exact logic, step by step. The expert advisor only evaluates a setup once per freshly closed candle, and it holds just one position at a time for its own magic number, so signals don't stack on top of each other. First, it builds context. It measures the net directional travel of the run feeding into the most recently closed bar, specifically, the difference between that bar's close and the close from runline bars earlier, which defaults to 5. Then it calculates the average candle range over the range window, which defaults to 14 bars. This average represents the market's own recent rhythm. The move is considered overextended only when the net travel exceeds stretch multiple times that average range, by default, 2.5 times. If price has covered far more ground than usual, the leg is flagged as stretched. Second, it looks for a rejection candle. The most recently closed bar must print a fresh extreme, a high above the prior window's highest high, or a low below the prior window's lowest low. On top of that, it must show a long rejecting wick into the direction of the move. The strategy measures the wick against the body and requires the wick to be at least wick multiple times the body size, defaulting to 1.5. It also checks that the rejection is skewed the right way, the upper wick dominant for a top, the lower wick dominant for a bottom. When an up move is overextended and the candle prints a fresh high with a dominant upper rejection wick, the strategy signals a short. When a down move is overextended and the candle prints a fresh low with a dominant lower rejection wick, it signals the mirror image long. Now the exits. For a short, the stop loss is placed just above the rejected high, plus a small buffer set by RetraceFrac, a fraction of the signal candle's range. The take profit is a snapback of RetraceFrac of the measured run, by default, 50%, back toward where the move began. The long is the exact mirror, with the stop just below the rejected low and the target a measured reversion upward. Every position therefore opens with both a defined stop and a defined target. Let's look at the actual MQL5 the expert advisor runs, the way you'd see it in MetaEditor. At the top are the input parameters you can adjust. Lots sets the trade volume. Runlen, defaulting to 5, is the number of bars used to measure net travel. Range window, 14, sets the window for the average range and the fresh extreme check. Stretch multiple, 2.5, is how far the move must stretch beyond that average. Wick multiple, 1.5, is how long the rejection wick must be relative to the body. RetraceFrac, 1/2, defines the take profit as a snapback fraction of the run, and buffer frac pads the stop. Below that are the two signal blocks. The short, or sell, condition is true when net run is greater than stretch. The up move is overextended, when the signal bar's high is greater than prior high, a fresh high, and when the upper wick is at least wick multiple times the body and larger than the lower wick. When that's all true, the code reads the bid price, sets the stop just above the signal high plus the buffer, sets the take profit below entry by RetraceFrac of the run, and calls trade.sell. The long, or buy, condition is the mirror. It's true when the negative of net run is greater than stretch, a down move overextended, when the signal low is below prior low, a fresh low, and when the lower wick is long enough and dominant. Then the code reads the ask price, places the stop just below the signal low minus the buffer, sets the take profit above entry by the same retracement fraction, and calls trade.buy. Both sides are symmetrical, and both define the stop and the target before sending the order. Let's bring the logic to life on a chart. What you're seeing is an illustrative GBP/JPY style sequence, and notice there's no indicator panel underneath, because this strategy reads nothing but the candles themselves. Watch the left side first. Price is sliding lower, candle after candle. The first several bars each close beneath the one before, and the move is picking up speed. The bodies are getting longer, and there's very little overlap between them. This is the downdrive the strategy is built to study. Internally, the expert advisor is measuring the net distance price has traveled over the last 5 bars, the run length setting, and comparing it against the average candle range across the previous 14 bars, the range window. By the 4th and 5th bar down, that net travel has stretched past 2.5 times the average range, the stretch multiple threshold, so the move is now flagged as statistically overextended. The elastic, so to speak, is pulled tight. Now look at the marked candle at the base of that slide. Price pushes to a fresh low, dipping below the prior range low line drawn across the chart, but it cannot hold down there. Sellers probe lower, find no acceptance, and the candle snaps back up to close near where it opened. That leaves a long lower wick, and the strategy checks that this wick is at least 1.5 times the size of the candle body, the wick multiple condition. A fresh low, plus a long rejecting wick, plus an already overextended move. All 3 conditions now align. On the open of the very next candle, the buy entry marker appears. From there, follow the price action upward. The stop loss sits just below that rejected low, beyond the buffer, at the precise place where the snapback idea would be proven wrong. The take profit is set as a 50% retracement of the down run, the RetraceFrac of 1/2, measured back toward where the move began. As the next candle's print higher closes, price climbs into that target, and the take profit marker is reached. Notice this isn't an open-ended trend bet. It's a measured reversion, a partial snapback toward the mean, with the reward and the risk both clearly defined before the position ever opens. Now the chart hands us the mirror image. After the snapback, price keeps drifting higher and builds a fresh updrive. Bar after bar closes higher, the bodies extend, and once again the net travel over 5 bars stretches past that 2.5 times average range threshold. The move is overextended, this time to the upside. Watch the next marked candle. Price spikes to a fresh high, pushing above the prior range high line, but the buyers can't sustain it. The candle is rejected and closes back down near its open, leaving a long upper wick, again at least 1.5 times the body. We now have the full short setup, an overextended up move, a fresh terminal high, and a long upper rejection wick that closes lower. On the open of the next candle, the sell entry marker appears. This time the stop loss sits just above that rejected high, beyond the buffer, and the take profit is again a 50% snapback of the up run, measured back toward its origin. As the following candles roll over and close lower, price slides into that target, and the second take profit marker is reached. Across both trades the pattern is identical, just inverted. Wait for an exhausted move. Wait for a rejection candle at a fresh extreme. Fade it, and aim for a measured reversion with the stop tucked just beyond the point of exhaustion. That's symmetry, long and short, is the heart of the overextension snapback reversal. That brings us to the end of our breakdown of the overextension snapback reversal. We covered what the strategy is, a pure price action, counter-trend mean reversion approach, how it detects an overextended move using net travel against the average range, how it reads a pin-style rejection candle at a fresh extreme, and how it sets its stop just beyond that extreme with a measured snapback target. We also walked through the MQL5 code and a candle-by-candle illustration of both a long and a short. Remember, everything here is educational information only and not financial advice. Trading involves real risk, and losses do happen. If you found this helpful, please like the video, leave a comment, and subscribe for more MetaTrader 5 strategy analyses. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.